Do commodities really protect your wealth from inflation? Imagine watching the prices of everyday goods like food, gas, and metals rise steadily over time. Now, think about how your investments might keep pace with those increases. That's what many people wonder about when they hear that commodities could be a way to guard against inflation. But do they really work that way? Let's look at the facts. Commodities are raw materials such as oil, metals, and agricultural products. These are traded on markets around the world, and their prices can change quickly. Inflation is when the overall prices in an economy go up, which makes money buy less than before. When inflation happens, the value of cash savings can shrink, so investors look for ways to protect their wealth. Many believe commodities can serve as an inflation hedge because their prices tend to rise when inflation increases. For example, energy and food are major parts of the Consumer Price Index, which measures inflation. When these prices go up, the value of commodities often goes up too. This direct link suggests commodities can help preserve wealth during inflationary times. Supply and demand also play a role. When the economy grows, demand for commodities like metals and energy usually increases. Higher demand can push prices higher, which can help offset the loss of purchasing power caused by inflation. Investors can earn a risk premium by taking on commodity price fluctuations, which might keep pace with or beat inflation. There are different ways to invest in commodities. Futures contracts let you agree to buy or sell a commodity at a set price in the future. Commodity funds pool money from many investors to buy a variety of commodities, spreading out the risk. You can also buy stocks of companies involved in commodity production, which can reflect commodity price movements. However, there are some challenges. Commodity prices are often very volatile, meaning they can swing sharply in short periods. This volatility can make it tricky to relying on commodities as a steady hedge. Also, commodities may not always move in sync with other investments in your portfolio, which can affect your overall returns. In summary, commodities can provide some protection against inflation because their prices are linked to the prices of goods and services we buy every day. They tend to rise when inflation rises, and supply and demand dynamics support this. But it's important to remember that investing in commodities involves risks, and they should be part of a balanced, diversified strategy.